Going on, everybody? Good evening. How's everybody doing tonight? What's going on, Norman? Looking for a steak and lobster? We're not serving that tonight, my friend. How's everybody doing tonight? What's going on, Aaron? Good to see you. Quite the day in markets today, isn't it? Definitely a unique day. It's not every day you get a nice trend day so significantly in both directions. Definitely doesn't always work out like that, but if you can catch it, yeah, another V day for sure. Yeah, that's been the common theme over the past few weeks, isn't it? Or at least few days, I should say. Oh, Norman, you're at this. You're in Oceanside at this Texas Roadhouse. Nice, man. I'm ready to get there. All right, a couple minutes after the hour, I'm going to send out one more message letting everybody know we're going to get started, and then we will get right into it. Second. All right, everybody. We'll wait for anybody else to join on in, but for now, I think we have everybody. Welcome in, everybody. Good evening. Tonight, big idea is going to be to cover the options Greeks. Now, with this topic, it's one that we've covered before. So, as always, going to do my best to cover it in a bit of a different way and make sure to answer any questions that you guys have that come up. But definitely not a new topic in here tonight. So, with that being said, let's not waste any more time and go ahead and get right into it. We haven't done a PowerPoint lecture in a little while, so just a quick introduction for those who haven't been into a class with me before. Typically, the way I like to structure these kind of PowerPoint focused lectures is by starting with concepts that are a bit more kind of simple. And then as we continue on throughout the lecture, the complexity increases. I like to think this lecture and any other PowerPoint lecture that you see delivered by me is structured kind of like you'd expect maybe like a college course to be. As always, if you have any comments or questions as we go throughout the class, don't hesitate to ask me them as soon as they come up. That said, just one other introduction. Technically, this is a class that's part of our beginners course series, lecture 2 in the beginners course series. So if you're interested in what we talk about tonight and like the format of this lecture, we have another 11 lectures as part of this beginners course series that have been delivered in some format before. So yeah, if you have that interest, definitely don't hesitate to go check out some of our older beginners course series lectures. We've covered all this information. Really, this beginner course series is used to develop new traders and really make sure that you guys have the fundamentals before moving on into trading too heavily. So that said, let's get right into the topic for tonight. Like I mentioned in the announcement, and also Archon mentioned earlier today, tonight we are going to be covering what is called the Greeks. And before I move on any further, who has heard of this term before? Who knows generally what we might be talking about tonight? Anybody have any ideas or baseline familiarity with this subject? Answering this question will help me just gauge kind of the okay. SK seems like he's got some familiarity. Okay, Vinny's got theta. Aaron's got the hand up. Cool. Okay. Well, it seems like some of us have some familiarity. Maybe the larger majority of us are pretty new to the concept. So no worries at all. We'll make sure we keep everybody on the same page. Let's get going. So, yep, like SK mentioned, the main five Greeks are delta, theta, gamma, vega, and rho. And for those of you who are already familiar with this concept, I want to just let you know with just a quick Google search, because I don't actually remember these off the top of my head. But there's also second order options Greeks, which are a little bit definitely kind of another level here of complexity, which are called charm, gamma, vana, vera, veda, and vama, whatever the hell that is. I think the most kind of common ones that you'll hear are going to be charm and vana are those second order Greeks that are more commonly referred to as. So if there's some studying that you'd like to follow up with after this lecture, this would definitely be a decent place to start. And hopefully, if you've never heard of these before, you now have a place to say you learned something tonight. So, yep, the Greeks, again, there's five main Greeks. And for the most part, really, there's two Greeks that are the most important, which are delta and theta. So we'll give a reasonably detailed introduction into all these in specific. But yeah, let's get right into it. So first of all, we have delta. And delta represents how much an options price is expected to change per $1 change in price of the underlying equity. Call options have positive delta, while put options typically have negative delta, which should be, not typically, they do have negative delta, which should be intuitive, right? As stock price increases, the call option gains value and the put option loses value. And as stock price decreases, put options gain value and call options decrease in value. So I just want to give a quick kind of example, which will bring out the good old notepad for this one again. So let's say, for example, the delta of an options contract is 0.5. And I'll just zoom this in a little bit so you can all see really clearly. Let's say the delta of an options contract is 0.5. The current stock price is 100. And the current option price is, let's just say it is $350. If the stock price increases to say something like 101, meaning that we get a dollar increase in price, our options contract will increase to $400 because the delta is 0.5. You have to remember that anything in the options world, you're typically going to multiply that by 100 because an option contract represents 100 shares. So in this case, our delta is 0.5. 0.5 times 100 is 50. And the stock price increased $1, which means we have to add the delta one time. So our option contract increased by a total of $50, making for a final price of $400. Now, delta in general is pretty simple when outlined this way. Just like anything in the options world, there's always more to the story. But does this first example generally make sense to everybody? Happy to rehash it if you guys like. Cool. All right. Cool. So, one other thing to note is that delta of in the money calls approaches 1 as expiration nears, and delta of out of the money calls approach 0 Again, this should be another kind of reasonably intuitive point, kind of like we talked about last lecture in the selecting options contract lecture. Further out of the money contracts are typically cheaper. And as we move closer and closer to the expiration date, the contract price decreases, and as a result, delta also typically goes down with it. All right. Again, delta is a pretty simple one. The next Greek, which I don't remember which one's next. Yeah, so this next Greek will make it a little bit more complex. Yeah, so let's talk a little bit about that. So the next Greek that I wanted to cover is called gamma, which is the rate of change of delta. And for those of you who have taken maybe a physics or calculus class before, you could think of delta as the speed and gamma as the acceleration, where gamma is the first order derivative of delta, or shortly known as the rate of change of delta. So essentially, as delta measures the amount of money our option contract will increase or change in value per dollar change in stock price, gamma represents the change in option contract price for per change in stock price. So for example, if the stock is at $438, our delta is 0.2 and our gamma is 0.1. After the stock price increases to $439 for $1, our delta increases by 0.1, which is our gamma. Does that simple example make sense at a high level? Cool. Any questions, comments, concerns so far? We feeling okay? Sorry for caps. Cool. Okay. So obviously these two examples are incredibly simple. It seems like this is just a perfectly linear change, right? Where gamma just stays 0.1 for the whole time, delta stays 0.2 until the stock price increases. But you have to remember that it's a much smoother curve than that. And I think I actually want to pull up, no, I'm not going to do that. I was going to pull up a graphing calculator online, but I think that's a mistake. I think I'm going to get too pigeonholed into something that doesn't matter as much. But just to highlight, right? Obviously, the stock price doesn't just wait for whole dollar, or excuse me, option contracts don't just increase based on full dollar increments in stock price, right? Even if the stock price increments a cent, we could see a change in the price of the option contract. So it's much more incremental. It's not a kind of black and white sort of change there. So for example, if the delta is 0.5 and the stock price only increases 50 cents, our option contract would increase by about by $25, which is half of a delta, to $375. And again, right, also you have to be mindful that that delta is changing as well. So realistically, as stock price is increasing, our option contract is increasing in value, and our delta is also increasing at the same time. So the price of the option contract's rate of increase, technically speaking, will actually increase. The price of an option contract will increase at a higher rate, or I guess higher interval, as the stock price increases as well. And hopefully that wasn't too confusing, but I just wanted to make it clear this isn't necessarily just a directly linear relationship and has a bit more complexity to it than just that. One thing that I want to add is you shouldn't expect to use these kind of elementary math equations in order to, I'll say, predict the price of an option contract, over the span of a few days, just because there's so many factors that can come into play. Typically, if I was going to, I guess I'll just introduce a scenario. If, for example, I'm trying to figure out what price I want to purchase an option contract at, I might look at the current price of the stock, figure out what the delta of that contract is, and do this kind of quick math to figure out in general where I should expect to be purchasing that contract. But in no way should this be some kind of detailed way where you do analysis and you're trying to forecast the future price of an option contract just based on delta and gamma. As you guys saw, there's five main Greeks of an option contract that are determining the value of that contract. And with that comes a lot of complexity, right? And I guess this is something that I probably should have highlighted at the beginning of the lecture, but the pricing model of an option contract is an incredibly complex formula. And with that, there's a lot to be mindful of. So I guess I could bring up the equation maybe just really quick, just to make sure you guys are all familiar with that. Let's call it model. Let's see if there's just a quick, okay. This is like kind of, I think, no, that's not exactly it. Maybe this is it. Yeah, I think this might be kind of some kind of model that represents it. You got some logarithms, you got some square roots, Anyway, it's definitely a complex model, so important to be mindful that there's a lot that goes into it. If you are looking to predict the price of an options contract at a kind of decent level of accuracy, one way that you can do that is using the options, I think it's option profit calculator, something like that. This online system is decent at best. Nothing's going to be perfect, but it's pretty solid for kind of determining prices of option contracts based on stock price as well as volatility. And we can just try that out really quick if we just take a look at SPY. And then we can select the contract as well. So let's just say, the 400 call, and we can just click calculate. And it'll give us the change. Oh, we'll just change the profit and loss, or we can change the value of the contract. So we can see the price of the contract based on price. So for example, if the price pretty much stays at 558 until expiration, this contract will pretty much not change at all. If price drops to the SPY, we'll see the price of that contract drop off as well. Anyway, fun little tool there if you're ever interested in using that. All right, theta, definitely every options trader's worst enemy here. Theta essentially represents the time decay of an option contract. And as I mentioned earlier, as the stock or as the contract approaches expiration, theta, or the value of the option contract, decreases at an increased rate, which the reason behind that is entirely as a result of theta. So again, right, as we approach the expiration, theta is essentially eating more and more of the value of that option contract away. And you can see that illustrated pretty decently in this graph here. So it's an exponential relationship, and you can see the further we are from the expiration of the contract, the flatter the slope of that option value curve, meaning that it's decaying at a lower rate. And you can see, kind of very simply represented here, as we get closer and closer to expiration, the impact of theta only becomes more apparent. And what we talked about, we kind of covered this in a lot more detail in the last lecture, where we talked about how to select different contracts, types of contracts that make sense for different trades. But just to rehash that discussion really quick and kind of give the theory behind it now. What I mentioned in the last lecture was, typically speaking, for a kind of scalper or a day trader, it's a little bit more reasonable to have a shorter term expiration contract. And the reason behind that is because as a day trader or as a scalper, you're planning on holding that contract for a shorter amount of time, right? You're not planning on being in that contract for a long period of time. So if that theta is significant, it won't have as much of an impact because you're not holding that contract for days on end. Whereas if you're more of a swing focused trader and looking for slightly longer term trades, holding contracts that are very close to expiration can be incredibly detrimental and can end up wiping the contract's value out overnight if the stock stays flat. And I might even just illustrate that really quick with the options profit calculator, because it might be kind of a good way to use this. So if we just select, let's see, tomorrow expiration call, that's pretty reasonable. I don't know, tomorrow expiration, we'll say 5:55 at the money call. And we'll select that. Then we'll click calculate, and we'll want the stock price range. Let's just see if the stock price is between 550 and 560. And go ahead and calculate that. So right now, our contract costs $1.69. Overnight, we should expect the contract to be worth $1.84. So literally, if the stock price goes absolutely nowhere, notice this, right? The current price of the SPY is 554.42. So 554, it's like somewhere right around here in between these two levels. We'll just go with the higher number just to make it a little bit more fair. If stock price literally goes nowhere overnight, like stays directly flat, we will be down 50% immediately. Even if the stock price increases $2 almost overnight, we are still completely in the red. We're down 6% here. We only begin to see profits once we see that stock price move up a little bit close, almost 0.5%, right? So about 0.4% is when we start to see profits. So we have to have about a maybe $2.50 gap up overnight in the SPY to be break even at minimum, right? And this is entirely because of theta, right? Theta is the main driver for the decrease in the contract's value as we approach expiration. And that was just showing the best case scenario, right? Best case scenario is we're either flat or we're in profit. But what happens if stock price slightly drops or significantly drops the equivalent amount, right? If stock price were to drop $2 overnight, that contract would be down 86%. And just to kind of compare to a contract with much more time, we'll pick an equivalent contract. Let's just go out to, the 11th of October, same strike, 555, and calculate that. Notice overnight, if the stock price stays flat, we're down a quarter of or almost 0.5%, right? So pretty much nothing. If the stock price stays flat for approximately a week, we're down 10%. If the stock price stays flat for 2 weeks, we're down 30%. But if the stock price goes up at open a couple bucks, we're up 10%. If it goes down at open a couple bucks, it goes 10%. So while our reward has been significantly decreased, right? So if we get a massive gap up, obviously we make much less money than we would on the weekly expiration. However, if price is stagnant, like it generally is overnight, I mean, it typically isn't a significant move overnight, at least typically within 1% during a more normal period, usually less. At that point, this contract would still show a modest amount of profits. But even so, if we still remain flat, there'd be no impact, right? Which helps illustrate why, as a swing trader, this sort of contract would be more ideal. Does that idea make sense to everybody and kind of the principle behind theta? Hopefully this helps illustrate it a little bit. And this options profit calculator actually is pretty good. So, there's always going to be things that it can't account for, but for what it's doing, it's pretty decent. And just to kind of show you guys a little bit more about using it, you could also factor in IV. So like for earnings, you could typically just say, like if you're trying to calculate what you're going to make on earnings, which that's usually a bad idea, but if you wanted to, you can factor in the drop in IV. Anyway, yeah, hopefully super helpful for you guys to see exactly how. Ooh, what is this? I have no idea what we're looking at here. What is this? I have no idea what this really is. Huh. Okay, whatever. Anyway, that's the big idea behind theta. I don't remember. Okay, I don't have any other examples for theta. And like I mentioned, really delta and theta are going to be the two most important Greeks. That's really what you're going to care most about as an options trader. There's 3 more Greeks to be mindful of, but for the most part, they have a much less significant impact on the pricing of an option contract. Delta and theta typically, or really truly, do carry the most weight. All right. Next one is Vega, which again starting to become a little bit less significant here. The only time that you're going to really see this one come into play with too much significance is going to be during earnings. And this is the rate of change in an option per 1% change in implied volatility. And we'll talk a little bit about this example in just a second. But essentially, as implied volatility moves up and down, the price of an options contract also moves up and down to deal with that change in expected move. Now, what is implied volatility? Does anybody actually know, or has anybody heard of the term implied volatility before? Anybody? I will take the silence as nobody has heard of implied volatility before. All right. Implied volatility essentially represents the market's expectation for future moves in a given asset. Yeah, exactly, Aaron. Yeah, expected move is a good way to kind of summarize it. Generally speaking, as implied volatility increases, the expected move in a given stock increases proportionally. So, for example, on a day like today, we probably saw a pretty big increase in implied volatility as we saw the significant volatility off the open in the market. Additionally, as a stock approaches an event such as earnings, the market knows that, right? And if, for example, implied volatility didn't change when we approached an event like earnings, it would be pretty easy to make money in the options market, right? Like, for example, if the market didn't ever care or factor in implied volatility, every time there was an earnings report, you could pretty much buy a single call or single put and be effectively guaranteed to make money. Whereas with the concept of implied volatility, it's much more difficult, right? Because you can't just essentially say, yep, no matter what happens here, I will certainly make money on this name. Implied volatility essentially sets a minimum level for an expected move. So, for example, when you're trading earnings, if the implied move or implied volatility is approximately 10%, the stock price needs to move 10% in order for us to make profit on our options contracts. So, implied volatility has a pretty reasonably sized impact on options contract pricing, especially as we approach things such as earnings. Also common to see the implied volatility increase on expiration days for the SPY that have an FOMC event, even events for individual companies such as Apple on the WWDC event where they announce their new products. None of these events are secrets to those who are pricing options contracts. And as a result, that all gets factored into the equation. So, for example, I have two kind of stock tickers shown on the right here, AT&T and SMCI. And in recent months, the volatility in SMCI certainly has decreased. But essentially, it's meant to just compare the two, right? These two names have a very significant difference in implied volatility. T certainly has much more implied volatility than SMC, or God, T certainly has much less implied volatility than SMCI, right? T will move, 10, 20, 30, 40 cents in a typical week, which represents about 1 to 5% of the stock price, where in the past, SMCI was moving, 10 to 50% in a week, which you could see the difference there pretty easily, right? Where SMCI is significantly more volatile than AT&T. Okay, the last one that I wanted to cover is called Rho, which this is one that essentially, if you forgot about after this lecture, it wouldn't really cause you any problems. Rho measures the expected change in an option price per 1% change in interest rates. And it is based on the risk-free rate or US Treasury bills. So essentially, as options rate or interest rates go up and down, the price of our options contracts also fluctuates as well. This has a super small impact, especially in an environment where rates are pretty steady, which for now that isn't necessarily the case, but all throughout kind of the 2016, I want to say, the 2020 period, rates were pretty much flat at zero the whole time. So anyway, yep, that's Rho, and that's really the last Greek for us to introduce there. I wanted to open up to questions to see if you guys have any questions or comments before we move on to the next section. Anything for me to cover again before we keep this going, or is everybody feeling all right? Can you explain what has to happen for your contract to make money on an earnings play? Yeah, that's actually a really very interesting question. We could probably use the options profit calculator to illustrate that. So in general, right, when trading, like I mentioned, when trading options during earnings, there's one main factor to keep in mind, and that is implied volatility, right? With any earnings event, the market knows and very clearly understands, just like the rest of us do, that when a stock reports earnings, there's typically a large move that comes after that report. And again, there's times where this doesn't happen, but very commonly after reporting earnings, a stock typically can move anywhere from 5 to hundreds of percent the following day. And it's a date that's set in advance 4 times a year, typically for most companies. So it's a date that everybody knows coming, and it's a date that comes with a significant amount of volatility. So with that said, the options market prices that earnings date into any option contract expirations. And I actually think it might even be helpful for me to just pull up TOS really quick, and we can just look at how that changes in the options chain really quick. So while I continue talking about this, let me just sign in really quick and get this up. Oh, come on, I have to get a mobile notification to sign in. Okay. So again, like I mentioned, as earnings approaches, the market understands this and prices this into the option contract's value. So let's find something with some earnings upcoming. Maybe, no, this should have passed. Dollar semis report. Let's think. Anything upcoming? Okay, Johnson & Johnson is upcoming in October, about a month. So let's take a look. The earnings date for Johnson & Johnson is 10/15/24. Let's go ahead and take a look at the options chain here. So 10/15/24, this specific options contract is covered by this expiration, so the October 18th expiration, and it may even be a bit far out actually. But you can kind of see the jump here. It's actually kind of insignificant when it's this far out, so it's hard to tell a bit. But you can see on the dates before earnings, the average implied volatility is about 19 to 18%. And then once we have a week that encapsulates that earnings date, implied volatility jumps to about 21% and then remains high after that. And let me see if I could find something with earnings that is a bit more soon. Let me just figure this out. I don't actually know what is reporting this week, so let's see if I can find something real quick. I want to find some kind of decent company, not just a random one here. Anything too crazy. Yeah, we're not quite in earnings season at the moment, so it's a bit hard. Okay, this one might be decent. LZN. Oh, no options. That's not helpful. I'll try one more time to see if I can find anything good. GameStop, is that really something that's reporting soon, or is this an old article that I'm looking at? It was just yesterday, so we just missed it. Anyway, what you would expect to see in the options chain is see an uptick in implied volatility as we for the option contract that encapsulates the week of that earnings report. So yeah, pretty hard to see here in specific, but for example, for some reason, SPY on this specific expiration has elevated IV. So anyway, kind of back to your question a bit more directly here. What has to happen for your contract to make money on an earnings play? And the way to answer that question, very simply put, is in order for you to make money on an options contract through earnings, very generally, the stock needs to move greater than the expected move during earnings. That's a minimum. So for example, if you are trading some contract, that's reasonably close to the money, and the expected move in that stock is about, let's say, $10. If the stock moves less than $10, you shouldn't expect to make any money, especially if the stock moves in the complete opposite direction. You should expect to lose a large amount of money. And I can just kind of show you what that looks like really quick, Aaron, on the profit calculator. That might be helpful for us to illustrate that really quick. So let me show you. So let's say, for example, we're trading this SPY October 555 call, right? Right now, if let's say, for example, we open flat, we lose barely even a full percent in terms of our overall P&L. Let's say, though, IV or implied volatility drops by 50% overnight. All of a sudden, if the stock price is flat, we're down 45-ish%, which this should very clearly reflect what you would expect during earnings. where you get a big cratering of IV. I think 50% is a pretty reasonable metric to use. And yeah, if IV drops 50%, you could see even if we gap up to 560, we're still down 10%. So all you need to do is move more than the implied move. And for the most part, you're going to be making money. And again, obviously, there's still limitations there. If you're selecting an absolutely outrageous contract, you probably won't make money either way. If you select a contract that's deep in the money, you probably would still make some profit if the stock doesn't outpace the implied move that's expected. Yeah. Does that answer your question, Aaron? I think the real moral of the story is that when trading earnings, you have to be really mindful that unless you're a reasonably skilled trader, it can be pretty difficult to actually, I'll say, predict or have an informed decision when trading through earnings. It's not good enough to just say, "Oh, I think this is going to go up because something random." So I'll just get some calls. Not right now, Norm. We'll talk about your stock later. Got to stick around. All right. So just talking a little bit about picking a contract again and just rehashing this and kind of summarize, it has nothing to do with opening past the strike price. Yeah. So Aaron, that can certainly help. If your contract is out of the money and then opens the next day in the money after earnings, that can definitely help for sure. But again, right, it's so nuanced when it comes to scenarios like that. I provided the general guidance, but yeah, there's going to be probably 1,000 scenarios that we could cover. What if this? What if that? And it's just impossible to cover all those with a blanket statement. But to answer your question briefly, Aaron, that could help. So again, right, I wanted to just quickly rehash the discussion that we had last week, which was all about selecting option contracts. Now, again, right, like we talked about last week, when selecting a contract, very typically scalps end up being a daily or weekly expiration contracts. And hopefully now you understand the theory behind that a little bit more, right? When you're trading a scalp, again, it's a trade that you're not going to be in for a very long duration of time. Especially for a scalp, that can be a trade you're in for the duration of a minute or 2 minutes. And as a result, theta doesn't matter to you at all, right? Why should you be caring about theta if you know you're going to hold the contract for under 10 minutes, right? Theta doesn't have enough time to have an impact unless you're planning on holding a contract for 10 minutes directly into market close. Then at that point, obviously, you'll have to use a little bit of common sense there. But generally speaking, right, as a scalper or trading as a scalper, your most concern or your biggest concern is really getting a good ratio of delta to the price of the options contract. So you'll want to be able to make a decent amount of money very quickly. So you don't really care about theta, and your main priority is going to be that delta. Day trades, again, could kind of follow a similar mindset. So, for example, again, a day trade is a trade where you shouldn't expect to be in there for really more than a couple hours. And as a result, it can be acceptable. Again, a little bit more nuanced to this specific statement, but it can be acceptable to hold those daily contracts. Again, right, you have to be mindful on those daily expirations. Theta is going to be eating at its maximum rate. So it's going to really degrade the value of that contract quickly. Outside of that, weekly contracts can also be acceptable, right? Although the theta is large, if you're only holding for a few hours, you won't really notice the impact of it unless the stock price really just stays flat, at which point you probably weren't in a good trade in the first place. Then finally, moving on to our swing traders, right? Those 2-week expiration contracts minimum are a great benchmark to start out when you're swing trading, only because, right, when you're holding trades overnight, you're going to have the impact of theta devalue your contract 24/7. And I don't think that's something that I highlighted very clearly, but the Greeks, specifically theta, acts 24/7. So overnight, theta keeps working. During market hours, theta keeps working. During the weekends, theta continues to work. And as a swing trader, you're typically at minimum holding the contract at least one night. And as a result, you have to be mindful that that theta is going to be eating for an extra 12 to 16 hours while the market is closed, and you can't do anything about it. So as a result, you typically want to select contracts that aren't going to get absolutely destroyed when you're simply following your trade plan, right? As a swing trader, your trade plan typically is to hold for 1, 2, 3, nights, sometimes, weeks, sometimes months. And as a result, you can't be selecting contracts that are just going to lose, 10, 20, 30% overnight from nothing happening. It's not an acceptable way to be trading. And hopefully those of you who are in last week's lecture kind of understand the theory a bit more as to kind of why these rules existed and why we outlined everything the way they did. But that really brings me to the end of everything that I had prepared for the evening. I want to just open it up to questions and anything else that you guys wanted me to cover for the next 15 or so minutes. Yeah, any really kind of questions, comments, concerns, things that you want me to revisit? Maybe any other. I mean, Aaron had a great question earlier, but anything else that I could kind of go back to and get your guys' questions answered on? What do you want to say, Norvin? You can say whatever you want in the chat. Anything else, guys? I'll unmute you when we know nobody else has questions, Norvin. I can't have you just going off on a tangent right now. Got to make sure everybody else. Aaron's feeling good. All right. Well, I mean, if really nobody has any questions, I guess I will have to. Yeah, the lesson was pretty straightforward, Gary. Sometimes this one goes a lot longer. Sometimes it's, I guess, this length. I mean, it feels weird to consider this one done so quick. But I guess I'll have to see what Norvin has to say. So everybody probably wants to cover their ears at this point. But all right, Norvin, what do you got? You're the last one here. You're the last one here.
Hey, Tostie, thanks for muting me. So what I wanted to say is that since we're talking about, options, I used to play same days, but I've noticed that it's been a beneficiary for me trading like 2 or 3 days after. So not trading same days or trading Friday expirations weeklies on the spies and Qs in the money. The volatility really favors you if you're in the obviously in the right side of the trade.
Sure. Yeah, Norman, also you're echoing really bad. So, okay, you remuted anyway. I was going to say this is like terrible. But anyway, Norman, that was actually a really good point for you to make. And I really do appreciate you sharing that. And I think that's a lesson that a lot of people, unfortunately, just have to learn for themselves. I know me personally, I just don't like the volatility with the same days. It's just too much for me, right? I'm not interested in having to babysit trades. And that's just me personally. You ask Flips the same question and he loves it, right? And you ask, maybe 50 other traders in the chat and they're all going to give you different answers. Me personally, the way I operate, I'm not interested in seeing my contract fluctuate, 10, 20, 30% every 10 minutes, right? That's not something that I'm interested in and that I want to get involved with. I prefer, trades that have less volatility, things that are more stable so I could clearly think and make informed decisions. I just don't like having to rush into making choices, which is what I personally feel like mentally when I'm trading those same days. So I 100% agree with you, Norvin. Me personally, I rarely even trade the weeklies as well, but totally up to you and kind of a personal preference if you're interested in that. And if it works for you, that's great. Me personally, though, I typically always like to get time on my contracts. There's no reason for me to do anything else. I prefer having that extra time because it just gives me one less thing to worry about, right? I don't have to worry about theta at all anymore. I'm not rushing against the clock anymore. So I can strictly just focus on my trade and following my plan, not have to worry about any external factors really impacting that, at least as it relates to just the option Greeks, which just helps me focus in and really just trade better, in my opinion. Yeah, but again, right, you could ask that same question to multiple other people, even multiple other analysts in the server, and they're all going to give you different answers, right? Some people are all for the 0 days, and that's great, right? It works for them, works for how they like to trade. Perfect, right? That's, not a problem. But either way, 0 DTE on Qs Inspire only beneficial on days like earnings report or Mag 7 or big news. Yeah, Gary, 0 days certainly have their place. Like, for example, yeah, trading during FOMC or trading during events, sure, go for the 0 day. Why not? And I think an important point that Flips and I discussed in the last lecture is when you're trading those contracts with more risk, it's important to change and adjust your position size as well. Like as contracts such as 0 days, or even those weeklies, as you know, on a Wednesday, Thursday, Friday, you should really be sizing that position down, right? You want to always keep your risk in the market pretty stable. And as a result, right, if you're trading contracts that have much more time, in my opinion, your risk automatically decreases, right? Because you're not going to see nearly as much volatility. So you could sign up or size up a bit more on those contracts with time. However, your returns are going to also diminish, right? You're not going to see 100,000% returns on those contracts with time very frequently. Whereas on those 0 days, the volatility increases very significantly, and it is incredibly common to see those 100, 200,000% returns. So as a result, you don't really need as much, and you shouldn't have as much size in the trade because your risk is so much more significant, right? I mean, you look at what contracts did today. I'm assuming there was, thousands of contracts that did over 1,000% today, especially same days, just on that move. I mean, even if you bought calls at the open, held them through the dip, you probably still would be up hundreds of percent, right? Which is, a win for the zero DTE traders, right? So there's a couple different ways of thinking about it. But anyway, yeah, exactly. And the price action, minus any option contract specific volatility has been plenty volatile. I don't see a reason to add any more tricks into that whole equation, but to each their own, I guess. That was a very good point, Norvin. I really do appreciate you bringing that up, and I am very proud to be able to say that. I didn't know what you're going to say, and I'm happy for you. And as a result, I will reward you by looking at VRT. I was actually looking at this earlier, Norvin, and to be honest with you, it looks really nice. Great to see this bounce off the 200 moving average here. Nice rising volume as we push through the moving averages as well. Oh, sorry, I'm getting a call. Yeah, anyway, nice rising volume as we push through the moving averages. So we're now back above the 50 and the 20 simple moving average. If we take a look at the short-term moving averages here, the EMAs, we just made it back through the 10 and 20 EMAs, and also we have this downtrend line from the highs that we could probably draw, maybe something like that, or you could redraw it to be like that. Either way, very clearly breaking above those recent highs. Norman, if I was going to get long on this one, it would be probably right above this 83 area at this point. Pretty clearly starting to shape up like a nice bullish pattern. Norman, if I was you, I'd be getting long above 83 on this one, probably with targets around 87. Oh, you're already long. 78 calls in the money for 927. Beautiful. Yep, I'd probably definitely hope you trim some today. Yeah, above 83, it's pretty clear skies. Up to about 86-ish is what I would be expecting there. And then above that, you're really looking to the 90s and probably 93s. But this looks nice, Norman. And this is a shared look within kind of a lot of the semi sector, right? I mean, very clear, kind of almost double bottom type of look here with that nice rising volume off the lows. NVIDIA, same idea. Marvell, same idea, even a bit stronger here. So really good look in the sector as a whole. SMH moving back to the moving averages here. So yeah, SG. All right, last one, Norman. Yeah, I mean, this has a similar look to it, honestly. This looks also, the price action here looks pretty nice. Also leading the market higher as well in the short term. Just taking a look at the weekly here. Sweet green. What the hell is this, bro? I have no idea what this is, but this actually looks pretty good. This is one of the better ones. Just made it back above this earnings low. Yeah, and Aaron, I will say, be careful. You're buying above 83 in this market. You got to be cautious. You see what happens with people trying to trade these breakouts. It hasn't been going too well. Even this break to the downside. If you try to go short on this, it would have been pretty bad for you. And today, again, even on the S&P, right, we closed right at resistance. So really important to see if we clear this 555. But yeah, if so, definitely looks like it's got a bit more room. Shares and leads. Can you tell me what contract is the most interest for SG, Norman? Yeah, I'll tell you that. SG. Okay, so just off the bat, Norman, these contracts have decently wide spreads. This September 20th has decent OI and volume, but the spread is pretty big. moving on to the next expiration here. Yeah, these all have pretty wide spreads. Honestly, I'd probably go closer to the money here, like the 33s, only a $10 spread, so a little bit more reasonable here. I think probably the 33s for October would be a safer bet than most, even though it doesn't have all the OI and volume I'd be looking for. Yeah, I would probably just stick with that, the money here. Further out of the monies, I just don't love the spreads further out of the money. And you know that those at the monies will stay solid even if price decreases significantly. So yeah, I'd say probably just the 33s, Norman, and maybe monitor the 35s. Oh yeah, even yeah, I mean you could go in the money if you want. The 31s for October look fine. Yeah, the 31s for October look fine. And yeah, if you wanted to go in the money, you certainly could. The 30s look okay as well. I mean, at that point, Norman, though, if you're going super deep in the money, you probably might just be better off buying shares too. All right, everybody. Well, appreciate your time tonight. That's going to do it for us for the evening. As always, any comments, questions, feel free to reach out and let me know. And yeah, we'll see you guys all in the next one. And hope you have a great rest of your week. All right, everybody. Thanks for the time. Good to see y'all. And we'll see you all in the next one.